Okay, let's just dive right into this explainer, because we need to unpack the highly nuanced and frankly pretty fascinating Q2 2026 financial reality of BrightSpire Capital. Look, if you follow commercial real estate, you already know the sector is navigating some incredibly choppy waters right now. But BrightSpire's recent quarterly report, well, it tells a story that absolutely demands we look a bit deeper than just the headline numbers.
Because here is the brilliant paradox we're looking at today. How on earth does a company post a GAAP net loss for the quarter, yet still hold a strong buy consensus, not just a buy, but a projected 29% upside from professional analysts? It seems totally contradictory at first glance, right? But stick with me, because as we tear through this data, the rationale behind Wall Street's optimism is going to become crystal clear.
So here's our roadmap for making sense of it all. We'll quickly reintroduce BrightSpire, dig into the hard Q2 numbers, weigh the headwinds against the tailwinds, and then finally evaluate the analyst consensus and the road ahead.
All right, Section 1. Meet BrightSpire Capital, the basics.
So just to set the baseline, BrightSpire, ticker BRSP, is a CRE credit REIT. Now you know that a traditional REIT is basically the landlord who owns the actual mall or the apartment building. BrightSpire, though, they're the bank. They own the debt on those buildings. They are the lender, which means their success is completely tied to whether those property owners can actually pay their mortgages.
Moving to Section 2, Q2 2026, the hard numbers and balancing the ledger. Okay, this right here perfectly frames our dichotomy. According to strict GAAP accounting rules, BrightSpire lost 15 cents a share. That translates to a net loss of $18.3 million for the quarter. Yikes. But wait, look at their adjusted distributable earnings. They actually showed a positive 13 cents a share, or roughly $16.8 million in the black. So how can both be true? Well, GAAP includes non-cash accounting charges, like setting aside reserves for potential future losses. Distributable earnings, on the other hand, strip away those accounting quirks to show us the actual cash flowing in. And let's be real, that is exactly what we care about, because that's the cash they use to pay out your dividends.
Which brings us to Section 3, headwinds and losses, or what's dragging them down.
A massive drag on their earnings this quarter was their CECL reserves. As you probably know, CECL stands for Current Expected Credit Loss. It's a mandated accounting standard that basically forces lenders to look into a crystal ball, forecast any potential macroeconomic pain, and set aside a reserve today. For BrightSpire, they actually had to bump this reserve from $87 million in Q1 all the way up to $100 million in Q2. That is a huge jump. We're talking 327 basis points of their total loan commitments. Now keep in mind, it doesn't mean they literally lost that cash today, but they have to account for it on the books, which severely dings that GAAP net income we just talked about.
But it's not all just paper reserves. They took over $9 million in real impairment charges in the first half of the year, mostly from older retail properties and a repossessed multifamily asset. Add in a couple of high-profile defaults, like a non-performing office mezzanine loan, and yeah, it's pretty clear they're taking some real bruises navigating today's tough real estate market.
All right, let's flip the coin. Section 4, tailwinds and growth, pushing forward.
Because despite those broader market headwinds, BrightSpire generated a massive $319 million in new loan originations in Q2 alone, spread across 10 closed loans. And they didn't stop there. They noted an additional $295 million in new senior loans post-quarter. Guys, this isn't just treading water. This is completely transforming their portfolio. Their loan book grew over 20% year over year, hitting right around $2.9 billion. They are aggressively putting fresh capital to work in much better, higher-yielding environments.
Furthermore, management is showing some incredible confidence in their own stock. During the quarter, they completed their largest quarterly share buyback to date, aggressively repurchasing 3.8 million shares. They dropped $21 million doing this at an average price of $5.46 a share. I mean, you know the drill. When management buys their own stock in bulk, it's usually a giant flashing neon sign that they believe the public market is severely undervaluing their assets.
And this brilliantly illustrates their rate sensitivity. A staggering 98% of their portfolio is floating rate. This is absolutely crucial. It means that as benchmark interest rates stay high, the yields on their loans automatically adjust upwards. It's essentially a built-in engine, constantly generating more interest income on that growing $2.9 billion loan book. Now, take a look at this. This is the absolute wow moment. The stock price has just been hovering in the low fives, but their GAAP net book value sits at $6.81, and their undepreciated book value is a massive $8.10 per share. The stock is trading at a drastic discount to the actual value of its assets.
This massive disconnect is exactly why management just bought back those 3.8 million shares, and honestly, it's the exact reason Wall Street analysts are paying such close attention.
Which leads us to Section 5, the analyst consensus, Wall Street's verdict.
When you look at the 8 analysts polled by S&P Global, they maintain a very firm buy consensus overall. Their average price target is $6.34. That target represents a nearly 29% upside from current trading levels. I mean, even the lowest price target of $5.25 suggests some upside, while the most optimistic analyst sees the stock climbing all the way to $7. Wall Street is looking at that aggressive loan growth, the massive buybacks, and that deep discount to book value, and they are overwhelmingly siding with the bullish thesis, totally looking past the near-term noise from impairments and credit reserves.
Finally, Section 6, the road ahead and future guidance.
Their action plan here is highly structured and honestly pretty aggressive. They're targeting a $3.5 billion loan book by the end of 2026 and aiming for $4 billion by mid-2027. They're also issuing a second CLO for fresh liquidity, shedding those risky legacy office assets we mentioned earlier and pivoting hard into the safer multifamily sector. The ultimate goal in all of this? To redeploy capital so they can comfortably cover that 16-cent quarterly dividend.
Which leaves us with this final, really critical thought to chew on. Given BrightSpire's aggressive loan growth, their massive share buybacks, and that incredibly deep discount to their true book value, we have to ask, is the current stock price completely ignoring the underlying potential? Wall Street is clearly betting that once the legacy assets are cleared out, this transition is going to pay off in a big way. So what do you think? Is this just a value trap, or is it the absolute perfect time to capitalize on a deeply misunderstood transition?